We're now in the heart of the autumn trading season, and uncertainty about the global economy is driving the action in world markets. Consistent volatility has been creating top-notch trading opportunities in everything from stocks to soybeans. Just in the last week alone, the Bank of Japan launched into the foreign exchanges yet again for a second round match with speculators, and the UK political system crumbled in the wake of a sterling crisis and a battered bond market that's left global money markets wondering what on earth could happen next. Hello, I'm Nick Quinn, and this is your weekly markets preview for Monday, October 24th, 2022. Without question, the start of Q4 has been a great time to be an active trader. Best of all, the action is going to intensify as the November Fed meeting and US midterm elections approach. We'll be here for you every step of the way, breaking down the key events and market drivers as they develop. This week, we'll hear from the Bank of Canada and the ECB whilst digesting a vital US inflationary metric. So let's get stuck into a few of the important events and asset classes to watch in the coming 5 days in finance.
We get underway on Monday with the German manufacturing PMIs for October. We're looking for 47.2 off the previous 47.8, so we're looking for a downtick in German PMIs. And the situation currently in Germany is not that great in the industrial sector, particularly given where the euro is sitting. So it is starting to cause some levels of concern. So what we would do is we would look specifically on Monday to trade the DAX. You can see this from last week's weekly preview. Not a great deal has changed. We have sort of like still forming this flag formation here currently from the September lows down here at 11,876. We're really much sort of like we are probing this resistance area here from the 2nd of September. If we do get any sort of like movement to the upside here, I suspect that we will be relatively contained up to 13,000. I can't imagine that we're going to be moving much further than that. And then obviously from here, with where we've closed from Friday, we'll be looking for some kind of rotation. You can see here we haven't managed to get above the high of this channel that's forming this flag at the moment. So we'll be looking for a rotation back down, and that brings us back down to this massive monthly support area from 2015, starting at 12,219, and then maybe this, if we get rotation back into this area, that will break this low down here from the end of September, and we could then potentially be looking for a further move back down to 11,331. Tuesday is going to be relatively light on the calendar. We do have some consumer confidence data for the US that will be printed in the US session. Now we're expecting that in itself to fall 106 off the previous of September's 108. You know, if we look at that in itself would create a dovish reaction in equity markets, and if we look at the way that the indexes closed the week, a very strong dovish tone to the weekly close here, and you can see here on the Dow Jones Industrial Average, the US 30, this is the CFD, you can see here we closed at 31,157. So we are now really pushing deeply into this swing low here, this initial resistance area from the 7th of September. I suspect that we are going to get more rotation, range-bound type trading environments in the stock market between now and the early part of November when we get those midterm elections. So I can fully expect that if we get a lower print now in consumer confidence, that is definitely going to put 31,600, those mid 31,000s potentially printed on the charts before the end of the week. If we do get anything that looks like a hawkish reaction, then that will definitely put a cap on the upper side here, and we'll be looking for some kind of a move that's going to push us back down to support at around about 30,000. By the middle of the week, things will certainly start to get a little bit more interesting as the central banks are back in the mix. The Bank of Canada is expected to raise interest rates by 50 basis points, 3.25% to 3.75%. Now, Tiff Macklem out of the Bank of Canada has been pretty much hawkish across the board, and nothing has really changed that. So you have to be looking at the Canadian dollar in the middle of the week. Now you can see that weakness in the dollar at the end of the week has just played very nicely into the hands of this December 2015 lost support range. We have sort of just really rotated back off there quite nicely, and we just ended the week resting just above this June 2020 support area, which is going to certainly contain price action, at least for now. Where do we go from here? Well, I think if we do get anything other than an ultra hawkish tone out of the Bank of Canada on Wednesday, I suspect that we will potentially be looking at this swing low from the start of October, coming in at 135. Any sort of push back down through there, that definitely opens the door for this June 2020 support area to be sort of pushed right to the bottom of its support area, and that will come in at 133.22. If that doesn't happen, I suspect overall we're going to continue to see some Canadian dollar weakness. So this chart is going to keep going in the upward direction, and I suspect it's just a question of time before we are printing daily and weekly closes above 140. All eyes will be on Frankfurt on Thursday, as the ECB is expected to raise by 75 basis points. And this brings into focus a very, very interesting dynamic now with the euro. These are the kind of interest rate levels that we've not seen since 2008, 2009. And, bear in mind that the euro was trading at 125 consistently back then. So it shows you just how far that we have actually moved. So if we look at the euro itself, now we have been stuck in this very technically beautiful channel for pretty much since the beginning of the year. That has still not yet broken. Now, commercial hedging interests have changed the balance. They are starting to hedge out risk of some euro strength, and have been certainly for the last few weeks. So given the way that we've closed Friday's price action, we are just starting to wonder now whether volatility out of the ECB on Thursday could provide the necessary momentum to break to the upside here on the euro. And if that is the case, then I suspect that it potentially will be a relatively sustained move. So it could be even quite broad in its range as well. And if that is the case, that pushes certainly targets by the end of the week potentially up to as high as maybe as 102 if we get a sustained push past parity. On Friday, we turn our attention to US inflation data, but not the regular CPI. This is the PCE price index, which is far more important, the personal consumption expenditure price index, because the Federal Reserve pays very, very close attention to this measurement, and that means as traders that we should too as well. We're expecting a slightly more dovish print on PCE for 0.5% from the previous 0.6. Now, the dovish hawkish play has been very, very, very well signposted in gold, and it tends to play into that very nicely indeed. Now, we had a dovish end to the week, and as you can see, the price of gold here closed very strongly to the upside on Friday, coming in at 1657. If we do get a continued dovishness throughout the week, then I suspect that what is that's going to do by the end of Friday is it's going to really bring into focus these September highs with a potential extended move all the way back up to 1700, 1730, something like that. Without that, if we do maintain a hawkish rhythm as we've had throughout the year, then that would then look to from here we'd really be looking to get rid of these low prints here at 1622, 1619. Those will probably go by the wayside, and that opens an extended move, potentially quite a swift move to the downside for gold as well. So plenty to be getting on with on Friday.
As we roll deeper into Q4, the world of finance still faces tremendous uncertainty. Runaway inflation, Russia-Ukraine escalations, and the US midterm elections are only a few of the key underpinnings currently driving market volatility. Of course, for the active trader, volatility equals opportunity. So regardless if you are trading commodities, forex, or bonds, the markets will produce an array of attractive setups over the coming 5 days. Don't miss out on the action, secure your spot in the trading room, and we'll see you for the next live stream.